Welcome to our deep dive on how to maximize your moving cash when transitioning to a new home. We will compare liquidity through high-yield savings accounts and guaranteed returns through paying down mortgage principal. We will use clear examples, diagrams, and quick decision rules so you can take action with confidence. First, let's outline what we'll cover so you know exactly where we're headed. In this video, we will cover why this strategy matters, when to prioritize liquidity with a high-yield savings account, when paying down mortgage principal makes more sense, how timing between your sale and purchase affects the decision, and exactly how to make principal-only payments. We will run through practical math and finish with a short quiz. Now let's set the stage with the scenario and the core problem we are solving. You are preparing for a higher mortgage payment by setting aside the difference now. The core question is where to park this cash for maximum benefit. Keep it liquid in a high-yield savings account, or use it to pay down principal on your existing mortgage to capture a guaranteed interest savings. With that in mind, let's first explore the case for liquidity and why accessibility can be more valuable than a slightly higher rate in the short run. Liquidity is king when your purchase is imminent, typically within the next 12 months, or when closing costs and move-related expenses could be uncertain. In this case, parking the monthly difference in a high-yield savings account ensures you can tap the funds quickly. While the yield might be around 3.3% or higher, which could be lower than your mortgage rate, the ability to deploy cash immediately for movers, temporary storage, repair work like painting or flooring, or a surprise shortfall in closing funds is critical. If the timeline is short or the numbers are fuzzy, you value speed and certainty over a marginally higher return. Next, let's pivot to the guaranteed return option, paying down your mortgage principal. If your liquid reserves are already sufficient to cover moving, repairs, and closing, then channeling the extra cash into your mortgage principal can be the superior move. When your mortgage rate, for example 4.5%, exceeds your savings rate, for example 3.3%, each dollar sent to principal is like earning a risk-free return at your mortgage rate. The crucial operational detail is to instruct your lender to apply the additional amount directly to principal. Otherwise, the payment may be routed to upcoming interest, diluting the long-term benefit. Now that we've contrasted liquidity and guaranteed return, let's walk through how to make principal-only payments correctly. First, locate your lender's documented process for extra payments, typically in the online portal or on your paper statement. Second, explicitly select the option to apply extra to principal only, or include clear memo language stating principal reduction only if mailing a check. Third, verify that the posted payment reduced the outstanding principal and shows correctly in the amortization schedule. Fourth, if your cash flow is stable, consider automating a recurring principal-only add-on. Finally, even if you are prepaying, maintain a reasonable emergency buffer. Next, let's summarize the timing factor that often decides which path is optimal. Here are quick mental math tools. A simple interest approximation uses principal times rate times time. For example, on $10,000 for 6 months at 3.3%, interest is about $165. If instead you reduce mortgage principal by $10,000 with a 4.5% rate, the avoided interest over 6 months is about $225. The difference is about $60 in favor of the principal prepayment over that time period. However, this advantage only holds if you do not need the cash for closing, repairs, or unexpected moving costs. With those basics in mind, let's visualize how timing between selling and buying changes the decision. This timeline diagram contrasts two scenarios. In the buy-before-sell path, you progress through offer acceptance, appraisal, underwriting, and closing on the new home while still holding the old home. That creates an overlap period where liquidity is critical to bridge two mortgage obligations and cover closing. After the old home sells, proceeds arrive later. In the sell-before-buy path, you first list, go under contract, and close on the sale, which puts the cash proceeds in the bank before you start the new purchase steps. With funds in hand, you can redirect more confidently toward principal prepayments. The diagram highlights decision points where liquidity is favored during overlap versus where principal prepayment becomes more attractive when proceeds are assured. Next, we will compare the two strategies side by side. On the left, favor high-yield savings when the purchase is imminent, closing costs are uncertain, an overlap period is likely, or your emergency cushion is thin. Quick access to cash prevents costly financing gaps. On the right, favor principal reduction when your liquid reserves are already adequate, your mortgage rate exceeds your savings yield, your sale proceeds are assured and sufficient for the new down payment and closing, and you can clearly designate payments as principal only. This comparison distills the practical thresholds that guide your choice.
Next, let's quantify the difference with a simple 6-month example.
This table compares a 6-month horizon for $10,000. In a high-yield savings account at roughly 3.3%, you would earn approximately $165 and retain high liquidity. In contrast, prepaying the principal on a 4.5% mortgage would avoid approximately $225 of interest, but the cash becomes illiquid. The quantitative difference favors principal prepayment, but only when liquidity is not needed. With the numbers in mind, let's look at a sample allocation split to balance both goals. This pie chart illustrates a sample allocation where 70% of the set-aside funds remain in a high-yield savings account for flexibility, while 30% is applied to principal. This blend can be useful when the purchase is close, but you want to capture some guaranteed return. As your sale becomes certain and closing costs are clarified, you can adjust the split in favor of principal. Now let's test your understanding with a quick quiz. Quiz time. You plan to buy in 3 months, are uncertain about final closing costs, and may need movers and storage. Where should you park the extra cash for now? Options are A. HYSA for liquidity, B. Principal-only mortgage payment, C. Certificate of deposit for 18 months, or D. Stocks. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is A. HYSA for liquidity. Because the purchase is imminent and costs are uncertain, accessibility outweighs the small return difference. Now, let's try a second question, focusing on rates and timing. Second quiz. Your current home will close next week, and the proceeds will more than cover your new down payment. Your mortgage rate is 4.5%, and your savings yield is 3.3%. What is the better use of the monthly difference now? Options are A. Keep all cash in HYSA, B. Apply extra to mortgage principal only, C. Put cash into long-term bonds, or D. Spend it on furniture now. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Apply the extra to mortgage principal only. Because you already have sufficient liquidity, and the mortgage rate exceeds the savings yield, principal prepayment produces a superior guaranteed return. Next, let's include an important disclaimer before we wrap up. This content is for educational purposes only and does not constitute financial, tax, or legal advice. Individual circumstances vary, and you should consult a qualified professional who can review your complete financial picture. With that noted, let's capture the key takeaways. Key points. Prioritize liquidity for near-term purchases and uncertain costs. Prepay principal when cash is ample and your mortgage rate exceeds your savings yield. Always specify that extra payments be applied to principal only. Recognize that buy before sell scenarios favor liquidity, while sell before buy scenarios favor principal, and maintain an emergency buffer regardless of the strategy. And to conclude, let's summarize your decision path. To wrap up, first, estimate your timing and confirm expected sale proceeds. Second, set a specific high-yield savings buffer for moving and closing costs. Third, if a surplus remains, and the rate comparison favors it, automate a principal-only add-on to your mortgage. Finally, after closing, reassess and rebalance between liquidity and principal according to your new cash flow and goals. Before you go, we have one final message. Thank you for watching. If this video helped, please like, share, and subscribe. Share your scenario in the comments and tell us whether you are choosing liquidity or principal prepayment and why.